Hello, everybody. We're just waiting for attendees to come in. Thanks so much for joining. Please do. Some of you are saying you've got no sound yet. I have got the microphone on, and please do let me know when you can hear. Please do let me also know where you've got where you are in the world, because it does seem like people are coming in from all over the place. You can hear me loud and clear. Thanks for letting me know, Patrick. That's brilliant. We're just letting people join. We've got a lot of attendees today, which is very exciting. And so many subscribers are joining us. It's been a while since I've done a live webinar, so excuse if there are any glitches. But we'll be kicking off very, very soon. I've got lots and lots of fantastic material, lots of slides to go through, and I really do hope this is going to live up to some of your expectations. I'm making a promise to do a lot more webinars in the coming weeks and months, so hopefully this will be the first of many. Great. Well, fantastic to see you all. Some of you are saying no sound, but some of you are saying you do have sound. I'm going to get going now. It's 6:02. We've got a lot on the call, and it's probably time to kick off. I know you've all got very valuable time, and everyone will get hungry if I wait too long. So let's get started. Okay, first up, sound now. Excellent. It might take a moment for your sound to come on. Right, I'm going to kick off. This is a webinar about the NAPS portfolio, but really this is more of a primer on investing with the factors of quality, value, and momentum. Investing in stocks that have the attributes or characteristics of good quality, good value, strong momentum, or some combination thereof. It's really a kind of a philosophy of investing that goes back, many, many decades, and we'll be covering quite a lot to explain. And so this is not just about the NAPS portfolio. I'm sure that I'll be explaining what that is. I'll be explaining how to find it on the site, but really more focusing on the philosophy and principles of the way that I go about doing this. And hopefully that will be very, very useful and a good learning experience for everyone. I've got Lawrence from the team here with me, who is going to help put out a couple of polls, which please do respond to, and also help answer any questions that I can't. So thank you so much, Lawrence, for being here with me. It's really, really, really fantastic having your support on this. So first of all, who's this webinar for? And I would say really this is everybody here is a subscriber to Stockopedia. Thank you so much for investing in us as we invest in you too. And I really, really appreciate your trust and business and everything. So thank you so much. It's been a really, really tough year in the stock markets for everybody, myself included. And I'm sure that many of us are nursing losses from the highs from 2021. So hopefully it's time for recovery now. Certainly the markets have improved, and we will take it from there. But I think you'll get everyone should get value out of this. But I think there are certain key sort of sets of people who might find this most useful. If you are sort of improving investor and you're looking for a time-proven framework that can bring a bit more discipline to your investment process, I think this will have great value to you. For more experienced investors, and as you go through life, you, like I do, you start managing some other portfolios for family, et cetera, et cetera. And I find this a very, very effective way to save time when managing share portfolios. So I think you will find this extremely valuable too. And I know there's a lot of you are dialing in from abroad, and I've seen two of you from the US and Canada and Australia, where we have many subscribers. And I will be sharing results from some of those markets later with the similar principles that I'll be explaining today. But that'll be at the end of the webinar. Just before I get started, this is a webinar for educational and informational purposes. Shares can go up as well as down, and I think we all are DIY investors here. There is nothing in here should be taken as advice. It's very, very much educational. If you do, I can't know your personal situation. Things are not suitable for everybody, and I do recommend you get sort of professional advice if you're uncertain on anything. And so I think it's important to just make that disclaimer before we get started. Who am I? My name is Ed Croft, if you don't know me. I am I am the founder and CEO of Stockopedia.com. And I started my career in Goldman Sachs Private Clients before I left, ran a small fund, and then got the bug on the internet and thought we've got to do something better for private investors. And it started as a hobby project, and it really has grown from there. And I'm really, really thrilled to see the impact that we have on so many private investors, both in the UK and abroad. And it's really, really exciting to have so many here today. And I think we've got today, right now, I think we've got, well, more than 700 live. So I'm really, really, really pleased to see you all. You can follow me on Twitter. I haven't been very active, but I'm planning on being in due course. So that is my handle on Twitter. The agenda today, I think the educational part of this will probably be an hour or more, maybe an hour and 15, because I've extended some of the slides after some of your questions. But hopefully this is an hour invested in yourself. I think obviously education is so important. I try and do it for myself all the time, and I'm hoping this can be of great use. We will, of course, do questions afterwards. Many of you will have live questions. I'll try and answer themes. I may not be able to answer every question, and many of you sent in questions beforehand, so I put some more slides together from those. Some of the things you'll learn in this webinar. I'm keen to sort of help you understand the basic principles of what I call factor investing and using the NAPS portfolio as an illustration. And that really covers some basic themes, such as how to select stocks that have a high potential for outperformance, how to diversify a portfolio, which helps build a bit more resilience to weather changing markets, and how to manage change over time and to maintain a high exposure to the return drivers or factors that I think are so absolutely important for building a good portfolio. I'll be showing you some of the results from 8 years of applying this process. So I'll be showing you the published results from my model portfolio in the UK, and also some tests I've done on international markets. And we'll get to some Q&A at the end. So hopefully this will be quite beneficial. So the UK NAPS portfolio. And why is it called the NAPS? It actually started, the first blog, it's because there is something called the nap hand in the card game Napoleon, and it's often been used in horse racing to describe a hand with good odds. And I kind of backronymed it into something, the no admin portfolio system, which kind of sums it up. It's trying to be a low admin portfolio system. And I've published this for the last 8 years, both at the start of the year and at the halfway mark. And I'm going to show you the results from the published selections of the portfolio. And I will share that now. Before I do, I want to explain some of the kind of selection rules here of how this portfolio was built. So first of all, it selects shares by sorting the market by stock rank. And I've adapted this over time, as I'll explain, but first of all, sorting the market by the overall stock rank, the one on all the stock reports that we all know, which is a QVM, quality, value, and momentum ranking. But I adapted it over time to use a couple of other ranks I'll explain in a mo, called the QM and VM ranks. It also excludes small and hard to trade shares. Generally, the cutoff I've used is about a 20 million market cap, so nothing below 20 million market cap. And trying also to exclude hard to trade shares, such as, there is the bid-ask spread. So when you're dealing in shares, you buy at the ask price or the offer price, you sell at the bid, and the spread between them can be quite expensive in going in and out of shares. So I've always tried to keep the spread lower, at least less than 500 basis points or 5%. But generally, for example, this year, I think all the selections were above, almost all of them were above 100 million market cap, and they had quite tight spreads. But so, it always depends on the mix. And to construct a portfolio, I often sort of called this the Noah's Ark of investing, 2 by 2 by 2 from each of the sectors. So 20 stocks from each of the 10 sectors we publish on the site. I'll explain that in a while. But I adapted it over time to sort of weight more into certain sectors and less in others, because some of them don't have many stocks. And I equal weight the positions. And then every year on a schedule, they were rebalanced. They'd be rebalanced, and generally that's on January the 1st. So that is the way that the NAPS specifically is run. And, there are lots of us on here, and I certainly don't recommend copying what I do. And I'm going to try and focus on the principles and themes of how this is done, so you can construct, if this is something of interest, your own kind of way of doing this kind of approach. But it's got great benefits in understanding the principles, even if you are a diehard share picker who spends all day learning about business models and so on and so forth, because there's so many portfolio construction rules in this webinar that you can benefit from. So this is the performance of the FTSE All Share since I began this portfolio in 2015. It's about 16% up, and this is as of the end of the year. And but that's on a price basis. On a total return basis, it would be higher with the dividends, which is about 3% a year. So just bear that in mind. And this is the NAPS portfolio, which has returned sort of by the end of the year about 180%. Now, I haven't factored in transaction costs into this, but I haven't factored in dividends either. And over my analysis, the average dividend yield has been about 2.7% per year. And the average transaction cost, well, if I include stamp duty, which in the UK is a tax every time you buy shares of about 0.5%. And if I include that and the spread and also a bit of commission and so on and so forth, the transaction cost could be about 2% a year. So dividends would more than cover the transaction costs, and they do every year. But I've conservatively excluded those for this comparison. So I think that's gives an illustration of how this disciplined approach has performed over time. Now look, you can see that drawdown from the high at the top of the bull market, and nothing in the stock market is immune from, if you're in a long only equity portfolio, you aren't immune from drawdowns. And you can see here, for example, the pandemic crash, the drawdown here, and if you're in equities, there's always an issue with drawdowns. You can't really avoid it. We'll talk about some avoidance strategies later, but that's kind of the idea. First of all, when I started the portfolio, it was all ranked by the StockRank QVM. But in about, I think it was the beginning of 2021, I went to a half QM, half VM rank. I'll explain what that means in a mo. So the strategy is pretty similar, but it has adapted over time. And I did some sort of odd portfolio construction rules in this little period where it went sideways, which I will explain as well later. So it hasn't been exactly the same strategy all the way through, but it's the principles that matter. Here are some of the annual returns, which I think are quite interesting. Basically, you've got the year by year. In blue, the NAPS portfolio performance, and in gray is the FTSE All Share, which I kind of use as a benchmark. And the average here, that's the arithmetic average. And essentially, you can see there have been 4 years with very significant outperformance, but there's been 4 years where it's underperformed, and its worst underperformance versus the benchmark was last year. And so it's, 50% of the years it's beating the market quite significantly. And you can see in 2020, it was, what is that? 38, 40% above the market. So that's where the outperformance is driven from. Now, the interesting thing is last year, why did it underperform? And I think probably most investors significantly underperformed the major UK index because it's market capitalization weighted. And that means that it was very, very heavily weighted to, large cap value stocks like Shell and BP and so on. So it was very tough for almost all equal weighted portfolios to compare with it. And not making any excuses there, but that is actually, part of the maths. So anyway, it's had a very good performance, much better than cash returns or bond returns over that time frame. And it's the compounding that made all the difference. And I'm hopefully we will not be in, a 1929 style bear market. And hopefully this recovery in the stock market will persist and continue. And that is, I don't have any predictions on that. I never like to predict the stock market at all, but we'll see. The other interesting thing is over the last 5 years, the NAPS portfolio beat the majority of actively managed funds. This is the IA UK All Companies sector, and it shows all the kind of UK focused equity portfolios. And the NAPS has done extremely well against that cohort. And I'm a big believer in DIY investing. Most funds that are marketed to individual investors are marketed are built for scale. And when you build for scale, you can't invest in more of the opportunities that might be better opportunities in terms of the exposure to quality, value, momentum, and so forth. And often the best ideas of fund managers do perform very well, but they have to own lots and lots and lots of other shares. And that creates a real drag on performance. So I think that's quite interesting and quite compelling. That's only over the last 5 years, and over the last, since inception, it's done even better. So I think there's some, it shows that the method is fairly valuable. So I want to just quickly show you a couple of things on the site before I go forwards. Firstly, if you don't know, if you go on the Discuss tab, in here you can see UK blogs, and there is a NAPS portfolio there. If you click it, you can find all my writing on this portfolio through time. And it's gone back to 2015, and there's at least a couple of years. And, there's quite a lot of thinking that has gone into this over time. I'm not expecting you'll go and read everything all the way back, but I kind of will go over and sort of, when there's wins, I try and be philosophical about it. And when there's losses, I try to be too. And so you can see some of these, the things that have gone in this slide are in this article or in the slides too. So you can go and have a good dig around there. I do actually track the portfolio on the site myself. Unfortunately, it's not shared with subscribers, but I'd love to publish it to subscribers too. And this is from a notional £100,000 from the start in 2015. And all the transactions are logged in there, and all the gains are tracked. And so I track it over time. So that's what I do. But don't try and find it on the site because you won't be able to. But I am hoping to get model portfolios on the site in future. So going forwards, the interesting thing here is it picks winners without picking stocks, this method. And I just wanted to review some of the outstanding names that have been held by the NAPS process over time, because it's quite interesting. And firstly, I want to look at the hit rates. So the number of winners and losers picked each year. And this again tracks from 2015 to 2022. And you can see the number of winners picked in each year. The first year got off to an absolute flyer. It was a really good up year in 2015 for the market. And there were 19 out of 20 were winners. And I thought, wow, that's absolutely brilliant. It's going to happen. That's going to last forever. And of course it didn't. You can see here that there were about 1, 2, 3, 4 years where there were more winners than losers. But last year there were 14 losers. 2018, there were 14 losers. And on average, it's picked 57% in a 1 year holding period have been winners in that year. So it's not, the odds have been skewed in it selecting winners, but there's no guarantee. It's not like, and what I'm really trying to do here is put the odds in the favor of selecting winners, but also in the interest of trying to make sure those winners outperform the losers, which is where a lot of the performance has been driven from. So let's have a look at some of the standout names. First up, this is a list of all the shares that have doubled in the portfolio on a 1 year holding basis. And I think there are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times that's happened. And there have been some amazing winners. 2017 was a fantastic year when Games Workshop was owned and IQE was owned, which were both up 260% excluding dividends, which was, they were both massive winners. And by the way, these price returns, I'm sorry, I don't have the exact number because I ran out of time to get the exact number, but they are approximately the right number. So, and then it's held IG Design, which used to be called International Greetings when it was held, I believe, Ergomed, Premier Foods, Frontier Developments, and Petropavlovsk, which was Peter Hambro Mining way back in the day, if you can remember back that far, when I first bought it. And they were all in 2020, which was the pandemic year. And some of the themes there, Premier Foods, sort of, all those brands we put in our larders or cabinets. Frontier Development was gaming, everyone was at home. Ergomed, healthcare, and that was gold. So there were lots of big winners that year. Dark Group, twice, always one of the highest ranked shares on the site for many years. It's now called Jet2, and 2 times it was in the portfolio and it doubled. And then Wizz Air, another airline, doubled in 2017. So the interesting thing here is that that's about 6.5% of the positions owned over that time period were doublers. And there are lots of sort of 50% winners, 25% winners, far more than that. But in any 1 year, often you find that one of those doublers drives a lot of the outperformance. And something I'll come back to later is that you've got to own enough stocks in a diverse portfolio to capture some of those, which in a kind of a more focused portfolio is harder unless you're a really, really fantastic stock picker. So I think that's an important principle. And so talking a little bit about the method, I want to say this is about simple habits repeated regularly without distraction. And I'm going to talk a little bit about 4 principles. And this is kind of just my little sort of mnemonic for thinking about sensible investing, really. Think about this as sort of 4 good principled ideas for investing any way you invest, if you're a stock picker, a systematic investor, or anything else like that. And it sort of starts with mindset. I used to do a lot of live seminars at shows and conferences called Managing the Monkey, and there's still one on YouTube, which is great fun. And I'll talk about that. So managing the monkey mind is really important. And the method is the next 3 principles. First one is to maintain a good exposure to return drivers or factors. That's the quality, value, momentum I always sort of talk about. And then diversify to have more resilience, to not have too much exposure in one sector or one type of share, because you could end up having a sort of a very single sector bet. And the last thing is to rebalance the portfolio, because things drift over time and your exposures drift over time, and you end up having an average portfolio. And this is something that all dynamic factor investing is kind of all about. And I'll be explaining each of these principles in turn next. So let's go on to that. The one key thing here is, I wrote this in a blog once, and it's always in my mind, that the principles are like a jazz sheet to riff on, where the precise rules I use in the NAPS are not a kind of orchestral score to recite. And I really, really implore everyone to think about that and, try and craft something that's, suits you, that suits your psychology, suits your mentality, if these themes are themes you're interested in. So, I prefer to be a jazz musician and sort of, improvise on the top of it. First up, principle 1, managing the monkey. And this is really about how a rules-based process is this essential to kind of avoid emotional investing. Now, my backstory is that I basically almost blew up in the financial crisis by being a really highly concentrated stock picker in a bunch of names that were very, very risky in hindsight. But I was so confident in it. And I think we've probably seen in the pandemic, a lot of people have ended up making similar kinds of mistakes. And I think of myself as a pretty smart, well-educated guy, but I still made some really foolish mistakes. And it's so easy to make them. And I think why I've become more of a disciplined, systematic investor, and I'm prone to a share pick too, by the way. But the reason I have is to try and control that, those kind of problems, being over-attached to shares and so on. So some of those kind of biases, that we are suckers for stories. There's a narrative fallacy, and we all believe in like Hollywood ending for all our stocks, and we get over-attached to them, whether that's a single share or whether it's a grand theme. And I've seen it so many times: dot-com bubble, peak oil, cloud technology, infinite returns from everything. And, blockchain is another. And we all buy into the narrative, and that really can often really end up hurting. So we're also very over-influenced by the news environment, which is, I believe, I'm always very suspicious of, because it's very PR driven, and the news also tends to try and scare us. It's headline driven, et cetera, et cetera. So it can scare you out of the positions. It can also get you into, hot things that are PR driven, and sometimes that can be quite negative. And we can often over project those sort of recent events so that, we make those mistakes. And I think that's a real issue. We have a kind of, attention deficit disorder as people, and these are very, very problematic issues for us. So I always think that having rules is the way to deal with these things. We also have a blind faith in gurus, and I see it on Twitter all the time. There are people that sort of crop up that are like, have massive followers, and they sort of have a creed, and then it all ends in the same sort of way. Obviously there are some absolutely brilliant people out there who do good things, and and can actually crack themes and move to new themes with aplomb. But we often have an authority bias, and that's something, and and I know lots of people on this webinar, and I say treat everything I say with massive skepticism, because I've got a platform to talk about these things, but I want to make sure that's true too. The other thing is seeking safety in the herd bias. We kind of all do what other people do, and that can cause problems. We ignore contrary opinion. We seek confirmation of our biases. We look for news that confirms what we believe. We avoid people. In fact, you see it on the bulletin boards. People get hounded out when they have contrary opinions, even on the small cap report sometimes. And I think we've got to really embrace contrary opinion, to be skeptical of our views, and to stop us being wildly overconfident like I was in the financial crisis. And I think a lot of what this sort of NAPS methodology is all about is trying to be less wrong, not more right. I'll talk more about less wrong in a while. And the other big thing we do often is we avoid realizing losses. We get attached to shares. And I can't tell you how many times I hear people say, well, I'm just going to hang on to this big loser and wait for it to come back. And I think that is one of the key, most expensive mistakes. It's called the disposition effect. But anyway, I'm not going to rattle on too much. I have already. But all of these issues, they make us make investment mistakes. I'm sure we recognize many of the things we've done in some of this slide. So under pressure, we make simple mistakes due to these kind of emotional biases. And that's been a big theme in my work, in founding Stockopedia and doing all the work we do on the data and everything else. And it's really, really sort of key as part of my sort of life journey. And I implore everyone to sort of think about these things. This is a Ben Graham quote. Ben Graham, father of value investing, tutor of Warren Buffett. People don't need extraordinary insight or intelligence. What they need most is the character to adopt simple rules and stick to them. And I love that quote. It really makes sense. And we are very bad at sticking to rules. And I think the principles of what I'm talking about today hopefully will help you build yours. So the second principle, exposed to factors or return drivers. And this is about how to craft buy rules using some of the principles of quality, value, and momentum. I like to say the three primary factors that drive stock returns, apart from the overall market direction, which is the biggest factor on stock returns, are quality, value, momentum. The idea that quality beats junk, cheap beats expensive, and strong stocks or leaders beat laggards or weak stocks. And I think it's important to try and understand these principles. And I think one of the hardest that people come to deal with is momentum, because the idea of picking stocks at higher prices seems counter-ethical to the idea of value, where you're buying them at cheap prices. But actually, private investors have got one of the best capabilities to actually invest in momentum. Funds really struggle to do it. And I think it's something we can all really benefit. There are the three primary factors I won't be talking about much here, but is that small caps tend to beat large caps, albeit at higher volatility. Higher yield stocks tend to beat lower yield stocks, but I consider that part of value. And there's also what's called a low risk or low volatility anomaly, where lower risk shares beat higher risk shares. And that's why we've got the risk ratings on the site. But these are all factors, the ranks are all constructed from the QVM ones. And I think that's important to understand. And very, very briefly, if you've seen me talk about this before, I'm sorry to reiterate it, but these return drivers have been proven for decades, first by practitioners such as Jesse Livermore. The fantastic book, Reminiscences of a Stock Operator, should be on everyone's bookshelf. He was the first to kind of realize that if you bought stocks at breakouts and new highs, the trend tends to persist, and the other way. He made what would be billions today and then lost them and bounced back. He was the great bear of Wall Street, he was called, or, he was an incredible man. He ended up killing himself, sadly, but he was probably one of the first to really capitalize on the idea of momentum. Value was obviously really well understood by Ben Graham as a reaction to that 1929 depression. He wrote Security Analysis and The Intelligent Investor, and he created all kinds of deep value strategies. We've got some of them modeled on the site. And the idea of quality was most promoted. Well, Phil Fisher influenced Warren Buffett, and this is all, and Charlie Munger really promoted this to Warren Buffett, of investing in higher quality compounding shares that can reinvest their profits at high rates of return. So these practitioners, and many like them, made lots and lots of money in markets before all the academics then started proving the sort of cross-section of returns in the market, that if you sort of sort the market for stocks and invest in buckets of stocks, let's say buckets of good profitable shares, buckets of cheap shares, buckets of strong shares, those portfolios can beat the market. And that's a huge influence on what we do at Stockopedia and went into the StockRanks. So I've written a lot about some of the academic stuff in the past, and I'll talk about it a bit later. But this is the general principles, and these return drivers have been proven for a long, long time. Obviously, your subscribers, you know where to find these on the site. They're on every stock report. This is a few months old, this screenshot, but Warren Buffett owns Oxy Petroleum and as a high-ranking share. And the way to think about these, I'm not going to go into huge details. There were some questions about how we construct the ranks. I will do another webinar in detail on that another time. So essentially, we use lots of financial ratios, and we build a composite ranking from 0 to 100, where 0 is worst for each of these. The way to think about it is, if it's in a 90 plus rank share, it's in the top 10% ranked in that market. And that's kind of the way I think about it. If it's a 95, I know it's ranked better than 95% of stocks in the market for that attribute. And so, there you go. The performance of the StockRanks has been very strong in the UK and most markets around the world, and it's very proven academically. And you can find this in the Learn section. Go to Learn and go to StockRanks. I'll show you in a mo. And you can see some of this performance tracking. And low ranking shares have tended to underperform. And so that's a kind of important sort of idea and sort of thesis on the market, is that it kind of acts like a chromatogram over time. And the better exposed shares to these ideas have a tendency to outperform. So the stock ranks, quality, value, momentum. I sometimes use the acronym QVM, which is the stock rank. And so if I say QVM, it's interchangeable for the stock rank, but you understand what I mean. QV, you'll hear me talk about, which is quality and value. Think of them as good, cheap shares. VM is value and momentum. So they're cheap, strong shares. And QM is quality and momentum. They're good, strong shares. And I think that's also whizzed through. But the reason that's important is because each of these has different attributes. I want to help you understand how to use them, but also use other financial data, like more detailed data like PEs and return on capital and so on, because they all have these themes. And I'm not going to go in, I don't have time in this webinar to go into the details of financial metrics like the return on capital, price to book and all of that, but I will do in another webinar. But I'm just talking about more the factor themes. So just going to quickly whiz through this table. So there's a sort method, for example, the stock rank, which has the factors quality, value, and momentum in it, which means it's good, cheap, and improving shares. One consideration in high stock rank shares is they're often cyclical shares, which is one thing to consider. And I'll talk about cyclicals and defensives in a moment when I get to sectors. The next rank is the QM rank, which I really love, but it's prone to invest in premium names or market leaders. And that's because it's high quality, high momentum shares and has no idea of value. So you often find higher valuations in high QM shares. And they're often flagged as high flyers on the stock, according to the style. The VM shares are value and momentum. They're cheaper recovery stocks that are turnarounds or turning around. They can often be lower quality, which can turn people off. But the idea of investing in value and momentum is one of the perennial best strategies. And actually, in all our tracking of the best strategies of all time since we've been doing it, it's the value and momentum strategies that have done best, and they've outperformed quality, value, momentum. So that's a little bit maybe too much detail for this webinar, but I did a speech on it at Mello a few months ago. Must do a webinar on that too. The QV rank, you can think about this as more of a Buffett-esque kind of approach, quality and value. They're good companies at reasonable valuations, but you often find they're out of favor shares. And the one thing I'd say about QV type shares is you need longer holding periods to accrue the returns. So if you're a contrarian investor, you like buying contrarian stocks, you often need more than like a 1 year period to really get the best returns out of them. So that's one consideration there. Whereas momentum, anything that has momentum in them, you can often do on a shorter holding period. The other thing is building your own rankings using financial ratios. If I have time, I'll do that. But using any of those factors and using the actual financial data we have and available for download, you can actually craft your own ranks in spreadsheets and so on and so forth. So you can sort of fit to your own requirements. So look, I'm just going to quickly jump to the site very quickly to show you some of these things and where you can find high ranking shares. So first of all, if you go into browse, and even if you just go to popular screens, you'll see at the top some links, the top stock ranks, top QM rank, top QV rank, top VM rank. It's one of my favorites. I'll click that. And you'll kind of see a performance chart, which is sort of been tracked ever since inception. And you'll see the top ranked shares according to that ranking. Now, one of the things, as I said, to be aware of is that if you were to just go and look at the highest ranked shares, you can often see many of them are in the same sector. There's lots of financials are high VM shares. The banks are very strong on this at the moment. And so there is often a sector skew, which is why I will come to that third principle of diversification in a mo. But you can see that this kind of style actually looks like it's breaking out to new highs. So there you go. So that's one way of doing it. We also have, you can find them here, top StockRanks screens, and they're all in a list. And there's others like styles and risk ratings down here. The guru screens are down here. The other way I like to look at this is by just literally creating a new screen. And if you click new screen, you'll get a page much like this. In fact, I'll do a complete fresh one. And this will be automatically sorted by descending stock rank, which is a good starting place. And of course, you can then start adding rules like, market capitalization and seeking shares that are greater than 20 million or whatever you want to choose for your rules. So that is one good way to get started in this. And you can change the sort order very easily by going in, clicking sort by, choosing stock ranks, and you'll see what I call the crossover ranks here, VM, QM, and the stock rank as a whole. So if I add VM there as an example, that's that there, and it will add it to the table. So that's some of the ways to kind of go and find that. I'll come back to screening later because I've got more to talk about there. But if you were, for example, you could actually build your own rankings. And one way to do that, let's say if you were to, for example, you wanted to sort the market by price earnings ratio, let's just select it, update, and you could find lots of sort of high or low ranking shares, add some more filters. And if you were to choose one of the tables you can configure like that, at the bottom right, you can download it, copy the data to a clipboard, and open it in Excel or Google Sheets or whatever you want. And that would allow you then to sort of create your own rankings, which is maybe a bit more advanced, but many people get great value out of doing that. So that's something to be aware of. If you do that, be aware that it only copies the top 200 at a time. So you have to sort of go through and do it multiple times if you want the whole market. So that's something to be aware of. The other thing is just in Learn. If you go to Learn, and you'll see stock ranks and ratings here. And if you click in there, there's lots of learning material about the different types of stock rank and some of the access to the lists. And you can sort of browse the history and performance of the different types of ranks there. So maybe that's a very, very quick summary of some of the ways you do that. So going on, one of the things I think is important here to understand is that investing in these sorts of high potential stocks is quite psychologically difficult. And deep value shares often have problems. Quality stocks, and by that I mean value stocks, have problems. Like, for example, you'll see a lot of energy stocks in deep value at the moment. That's because the market hates them. The market is so pro for renewables and hates oil and all that kind of stuff. And they're quite capital constrained in that sector at the moment. And you often find that as the market changes, value stocks have problems, which actually is where some of the returns come from because they get sold off too cheap. Many institutions can't actually even buy these kinds of shares because they have mandates against it. Quality stocks are often boring. Now, I know many of you are brilliant investors on this call. So I know you'll probably understand that investing in high quality shares is a very, very profitable activity, but so many investors find them boring, and even fund managers do. Fund managers' bonuses are often sort of dependent on them doubling in a share, finding big winners and like outperforming, getting above their high watermark, so they get performance fees. So often they don't invest in them, and that means that quality shares are often underpriced. And momentum stocks will give you vertigo because trying to buy them at a high price is really difficult. And I just experienced this. I'll talk about it later in a portfolio I've been building on this process, where I bought U Group and Smith News, and it's really hard to buy shares at new highs. But as Sir John Templeton said, it's impossible to produce superior performance unless you do something different from the majority. It is actually important to understand that high factor exposure shares often do have risk. High quality shares can often be expensive. And we saw that in the last 18 months. High quality shares have really, really mean reverted. The valuations come down a lot. And value stocks can often go out of favor for years, and momentum shares can sometimes crash. So you can get these periods where this sort of strategy can underperform for significant periods. So it's not without risk, and but equities do have risk. And oh, by the way, I have written an ebook. I've bashed out 30,000 words on the StockRanks, which I hope some of you might read. There might be some of you on the call who I've invited as a beta reader, and thank you so much if you have. But I am going to finish this and integrate the feedback that 24 readers have given me into the final tome. And there'll be more on that in the next sort of few months. So please keep your eyes out for that, because you'll learn a lot more from that. So I want to go on to the third principle of portfolio construction, or diversifying for resilience. How to construct a portfolio to survive in volatile markets. Well, this is something I think is very simple but little understood. And I think back to the mistakes I've made, and I really could have benefited from not investing so much in Chinese AIM stocks back in 2007 to 2009. Diversification is a hedge for ignorance, so Warren Buffett says. And so many investors really highly concentrate their portfolios. I think this is one of the most dangerous quotes in finance, because I think people misunderstand what diversification means. And I'm going to explore this a little bit, because I often think, one of the things I've understood from the research on private investors and conversations with friends, and is that the average investor only holds 4 stocks, often in the same sector. And that's taken from big studies of tens of thousands of private investor portfolios. Now, I know most people on this call will hold a lot more than that, but people often take that concentration idea to heart and think, I'm going to get rich or die trying. It's YOLO as it's known. And yes, you can get rich. Of course you can, if you only own 4 stocks. Lots of good books about it. Bill O'Neill and others, focus on this. But it depends what you want out of your investing. I'm probably about to sneeze. Excuse me. Hopefully it's not 3 sneezes. So I want to talk about how many stocks are enough. I want to talk about how diversification across more names helps you capture the returns from factors. So this is a chart from 2021, and someone's saying, how to find growth stocks? One of the good places to start is the QM rank, high flyers. It's a good place. I can't answer questions while I'm doing this because I'll be on too long. The average return of 168 90 plus ranked stocks in 2021, this is on an annual period, was about 25%. So you can see that track there, bang, 25%. Let's have a look at a random stock pick from the 90 plus ranked set. And I've just done this of 30 random picks from the 90 plus ranked set. And as you can see, some of them doubled, some of them nearly halved, and it's pretty wild. Sometimes if I keep clicking run on my script that does this, you find some which sort of go crazy in both directions. But you can see a huge spread. So a one stock portfolio, if you were in 2021 when the market went up 25% and you were down 40%, or you picked those 2, you'd be pretty pissed off. And the important thing about the ranks is that they work on averages, and you need diversification to capture some of the returns. So if we look at 5 stock portfolios, and this is the kind of distribution you might see. This is 5 random picks. And yes, some portfolios do 60%, some portfolios did negative. And if I bought 5 90 ranked shares and I got minus 10, 20% that year, I'd be, very, very cross. But it's important to understand that this is the nature of rankings like this. And a rank is not a buy recommendation. It's just an exposure to certain factors that work on average over many stocks. So let's go up to 10 stock portfolios, and you start seeing a sort of more of an aggregation around that 25% mean. And still 10 stock portfolios have some lower returns. 20 stock portfolios, much more concentrated around that 25%. You're kind of looking at 10%, 15% in either direction. 50 stock portfolios, even more concentrated around that. And I think what I wanted to get across here is that if you are investing in higher StockRanks shares, one of the things you want to do is avoid the scenarios where you radically underperform the market. And I think that's because coming back from radical underperformance is hard. And that's why I like to diversify more. Unless you are a brilliant stock picker and you can pick, the better shares, which many of our community can. And, it's a real skill, takes a lot of effort, and, many can do it. So I think it's one of the things I wanted to help people understand is that diversifying across more names is not just to reduce downside risk, but it's to increase potentially the chance of upside, because holding more stocks reduces the risk of outlier downside performance and increases the probability of holding some of the bigger winners. So that slide I showed earlier, where you get those 100, 200% winners in a year, you're more likely to capture some of those if you have more stocks. Depends on how much research you're doing in the names. But like the way I do it so often is just purely systematic. So that's kind of a principle that I have. This is from Joel Greenblatt. He just said, if you're doing a limited amount of work on individual stocks or no work at all, like most investors, diversifying with 20 or 30 high-ranking stocks is most definitely the right plan for you. And I think that's quite a good quote from The Little Book That Beats the Market. Huge inspiration on the StockRanks must read. Next, I want to talk a little bit about the number of stocks in a portfolio versus portfolio size. Most of our subscribers have larger portfolios, but I know many are getting started. And, I know some of my sons have got their ISAs and lower amounts of money in them. And so one has to remember that if you try and buy 50 stocks in a $5,000 portfolio, you're going to probably have costs of 17% a year or something. So it's just completely ridiculous to even attempt it. But the thing is, even if you only got $5,000, investing in like 5 or 10 stocks, you will learn so much. I think there are great benefits from doing it, but it's important to be aware of that. But obviously, as portfolio sizes grow, the kind of drag from transaction costs and stamp duty and everything else, and the turnover of a portfolio, and this is presuming that the whole thing is rebalanced 100% every year, that it can be significant. So that's worth being aware of. So let's talk about sectors, the second thing, or other groups indeed. So diversification helps you capture these returns. I like to think of this as like a sort of football team. You'd never feel a team go play the World Cup all with centre forwards. You just, get completely thrashed. So you need to have a good defense and a good offense. And that's a good way to think about your portfolio. Which stocks are playing the defense in your portfolio and which are playing the offense? And the reason, again, I say this is because it's quite important to be less wrong rather than being all right. Now, I know some people will disagree with my ideas here, but this is the way I like to do it. And I'll explain why. So on the site, we've got 10-level classification based on every stock's economic sector. And on the portfolio allocation tab, you can actually see the super sector that we sort of bundle these in. So defensives are things like healthcare stocks, consumer defensives, and utilities. In the pandemic, consumer defensives and healthcare stocks went ballistic. So in bad market environments, defensives are generally rewarded. Sensitives are more sensitive to the economic cycle, industrials, energy, telecoms, technology. We've seen a big sort of tech contraction and so on. Often these sensitives go in, they're not necessarily all cyclical at the same time. And the more deep cyclicals are basic materials, consumer cyclicals like, cars and fast fashion and all that kind of stuff, which often people stop paying for when times are tough, and financial. So I like to think about it in these kind of groups. And I think it's, the NAPS tries to buy one or two from each sector. Generally, in the last however many years, I've chosen one from utilities and one from telecoms, and I fill with the kind of highest ranked 2 in all the other sectors, and I fill a third in a couple of sectors to make up for it. But you might be someone who prefers like certain sectors, and there's the important thing is just to have diversification across different sort of themes. This is some of the returns that I found over the StockRanks in different sectors over time. In the top quartile, 75 to 100 versus bottom quartile, 0 to 25. And you can see healthcare has been the best, but there's very few stocks often and that's very skewed by the pandemic returns. And we can send out these slides and share them afterwards. So if you're taking screenshots, please know we'll send them out. But certain sectors do better than others. And you can take from this, for example, consumer defensives and utilities, I'm saying a defensive sector, they don't necessarily look like they've done as well, but I find that they give huge spine in bad markets. So here's an example of the 2022 market, and it was the defensive exposure that saved the NAPS that year. The defensives were up strong, whereas cyclicals were down massive. So if you were in like consumer cyclicals and, you know, those sort of areas, it could be, you know, quite negative. So I like having that, you know, defensive backing in the portfolio. And I've seen shares like Drax, and I think last year, which ones were the winners? I can't remember, but there was some, I think Centrica did really well with obviously all the gas issues, and you can see that consumer defenses and healthcare stocks held up really well too. So I like that defensive exposure, and it sometimes makes up for, you know, the bad markets. And obviously in go-go markets, you often find, you know, the other sectors take over. And I like that kind of all-weather portfolio myself, but some of you may be able to time between different sectors and factors. So let's go. So diversifying across sectors, sizes, and styles creates a more resilient portfolio. You can obviously diversify across other groups, countries, and so on and so forth. So on the stock reports, I find these classifications really helpful, and they can be quite helpful for portfolio construction. So there are actually 5 groups I'd talk about: sectors, risk ratings, I won't talk about in this webinar much, size groups, and the style, which is based on the StockRanks. And the other thing is obviously countries and regions. And I know many of you do diversify across other countries and regions. Now I'm going to show the international returns to the NAPS in a while. I want to quickly show you sectors and groups on the site, just show you where you can find it. So if I flip here in browse, if you go to sectors, you can browse the sector pages. So all 10 are here. And there are also industry groups. We've got 52 industry groups. You can look at some of the data on them, but also let's say I want to go and find good healthcare stocks. I'll click in here and you can sort of browse that sector. Depends on your region. You know, we've got 7 regions that you can subscribe to. And, you know, I will show some of that later. But for example, in the energy sector, you can see Spire Healthcare, which I think is in the NAPS, and it's also in a portfolio I just bought for a couple of weeks ago. I should disclose that. And Indivior are the higher ranking ones, but there's no 90 pluses. And you can whittle down into, for example, biotech, et cetera, et cetera. So different sectors, you tend to find very, very different rankings. And, you know, this is a really good way to go browse the market and look for, you know, diversifying your portfolio if you're trying to find and build out in a certain sector. The other way I like to do it is using screen rules. So if I go new screen again, and I just show you, if you click add rule, if you go under profile, there's the classifications, and these are really our groupings. And you can see sector, industry group, risk rating, size group, style. Those are all on the stock report, as well as country and region. So if I was to choose sector as an example, we can go sector includes or excludes basic materials. Let's say I want to look at basic materials and energy stocks. There we go. And it's filtered it right down, and that's super helpful. And I can also go and add rules, for example, for size groups. If you don't, which is, you know, just finding, if you want to look at large caps or mid caps or whatever it is, or you want to exclude micro caps, that's how you do it. And that's giving me 55 results of large and mid caps in basic materials and energy. So the screener is super powerful. You can save it. It's all in your sidebar, which you can reorder. Some people don't know that. If you click the toggle, you can reorder them. And it's super powerful. And I do recommend having a look at it. Obviously, also, if you go on to the stock reports, you can find, if you pull them up by search, you'll see the sector and the industry group up here. If you've come from a portfolio, you won't have them there, but you've also got the sector here. And further down in the profile summary, you've got sector and industry. So it's just another way to go and look at it. So that's all I wanted to say for now on that. Principle 4 is rebalancing. I know time's ticking on, and hopefully I'll crack through this. But principle 4 is rebalancing on change. I want to talk about sizing positions and managing them through time and events. I'm not going to have enough time to go into this in super detail, but I hope to do a lot more educational material in coming months. So how to size your positions. Now, there's lots of different ideas on this. Some people equal weight, so same amount in every stock. Some people rank weight or even confidence weight their positions. So if you are someone who's a stock picker and you have very high confidence in your positions, some people really do position size much more heavily in their biggest, what they think are the biggest opportunities. that me in the financial crisis, I put a lot of weight into things I thought were amazing and hung on to them far too long. So you can be wrong. We're prone to overconfidence. But if you are a very good investor, you can do that. And by what I mean by rank weight, not just stock rank. I don't mean stock rank weight. I mean kind of rank weighting for your confidence in the opportunity. The other way is to risk weight. So some people will invest less in higher volatility shares and they'll invest more in lower volatility shares. It's a bit advanced. But really, as I said, be wary of overconfidence. Keep it simple. I believe equal weighted positions are good enough and they work very, very well. So in a 20 stock portfolio, it's 5% in each position. And that works very well for me. And I quite like doing it. So for example, in 100 grand, 20 stocks, 5K position size. So that's something to know. So why rebalance positions over time? Now, somebody did talk about, yes, Warren Buffett, he holds forever, right? And one of the reasons he does that is because he doesn't have to pay capital. He doesn't have to pay capital gains if he sells. And of course, he is probably the best quality investor there is. And I think high quality stocks deserve longer holding periods. And if you are the best investor in quality stocks in the world, you probably can hang on to them forever. But even he makes mistakes sometimes, and he gets rid of them when they're bad stocks. And I'm sure many of you know some of the names he's made mistakes on. So the idea of rebalancing is when the facts change. But the thing about Buffett, and the thing about if you're an individual investor with a tax-efficient portfolio, let's say an ISA, you don't have to pay capital gains. So you keep all those gains. And that actually means that actually transacting in shares becomes far more viable. You're not going to have that drag of capital gains on your returns. So that's really important to sort of understand. But you might rebalance because prices change and your position sizes change. Over time, that creates more risk. The valuations may change, the businesses may change. If you're a stock picker, that creates risk. Often people sell based on business change. And the original factor exposures, the QVM drivers, they will change and they will fall. The one inevitable is if you buy high ranked shares, they will not have the same average rank a year later. And I'll show that in a minute. If the position size is, let's say at the start of the year, if you imagine your position size 0 to 5% here, and all of them at the beginning of the year are the same, by the end of the year, they might look like this, with a real dispersion of position size. And if you've done 260% in the portfolio, what would that be? That'd be like 16, 17%. Some people get up to 20, 30% of the portfolio. And I was reading about one person who had, a very huge position size, and then it sort of fell by 70% the next year. So it creates a risk. And actually, you can get a rebalancing premium. And I've seen it again and again. And in Indivior, the NAPS has owned again and again and again. And it's been a very volatile share, but it's significantly beaten the stock's performance over time just by rebalancing back to equal weight. So that's something to be aware of. And the other thing is your exposure to QVM drifts. So let's say the NAPS at the start of last year, this is the stock rank now here on this axis and 20 positions. The average rank was 91 in that portfolio. And at the end of the year, the rank had fallen to 74. So look, some of these had gone down to even a 25 rank. But the way I've done it with the NAPS is that it just holds for a year. So you can see, if you want to actually maintain a high exposure, you've got to get rid of some of them and sort of load up again with higher quality, higher value, higher momentum shares. That's kind of key. We do have a really good tool on the site, which is called the bubble charts. And I don't know if you know about this, but I'll show it to you on the site in a minute. But if you were to map the quality rank and the value rank, as just one example on two axes here, you'd have low rank shares, expensive junky shares down here. And the blue things being, say, portfolio holdings. At the start of a year, if you bought very high quality value shares, they might be up there. But over time, it might drift. And of course, you're going to have to do something about that if you want to, stay true to the discipline. So I think that's an important principle. So let me just quickly show those bubbles on the chart. So if I take an example, which one should I do? Let me just do this one. If you're on a portfolio, and this is just a watch list of bad shares, but if you go over here, on the right on any portfolio or table view, there's a little bubble view here, which I think is super cool. And this shows, and you can look at this quality value or value and momentum or quality and momentum. And it will map out, this one is quality momentum. So you've got momentum here and quality here, all the stocks as bubbles. And I find it such a great visualization on a portfolio. So for example, for the NAPS this year, if I do the same thing, at the moment, it's only because I use QM and VM, you can see there are some stocks up here, some over here. Because what I've tried to do is buy half value momentum, half quality momentum. And quality momentum shares are more expensive. And interestingly, anyway, I've got the idea across, and I think that's important to realize. So rebalancing is one of the simplest and yet one of the most powerful ways of buying low and selling high, by Professor Andrew Ang, was written loads of great writings. He's a great professor I follow. He's now head of factor strategies at BlackRock. And I think it's a really important thing to understand. There's two real key approaches to rebalancing, and I want to make this clear. Firstly, time-based, which is a more passive approach, which is what I do on the published NAPS. That's calendar rebalancing, for example, annually or semi-annually on a certain cadence. And one of the things I like to do in some of the ways I run my spread bet portfolios, do a quarterly. And so it's still kind of annual rebalancing, but it's more a quarter and a quarter. The other way to do it is threshold based, which is more active. It means you need to be more active and can be a better approach because you can take advantage of more opportunities. For example, it might be when positions double or halve, or it might be when the stock rank below some arbitrary level versus your starting rank. And I'll show you something because there's some great research on threshold-based rebalancing. And for example, you might also be someone that uses stop losses. There's always lots of questions on stop losses. And there's also people use technical signals to get in and get out. So thresholds can be much more expansive than just rankings or P ratios or anything else. So time-based rebalancing, as I said, the ideal frequency depends on, for example, your account status. Like I said, if you're in a UK ISA, or I think in America they're called IRAs, you can avoid capital gains tax. I think in Australians have their own way of having a tax efficient pensions and so forth, and you can avoid capital gains by using these kind of wrappers, and that can allow you to rebalance more frequently. For example, if you have a larger portfolio size, you'll have less commission on your trading, so potentially you can trade more. But if you've got a larger account, you'll have more frictional trading costs in small caps. So you have to bear these factors into mind when you're running a portfolio and try not to do anything daft. But I mean, personally, I believe annual rebalancing is kind of ideal for most investors. That's something Joel Greenblatt also said. It kind of gets the more you rebalance, the more costs you have. And you're going to have the spread cost, you're going to have stamp duty in the UK, even in an ISA, you're going to have commission and so forth. So you don't want to rebalance too frequently because it just is a real drag. And like I said, staggered rebalancing is quite good. Threshold based is, as I said, more about like having limits. You might buy at a certain level and sell at a certain level. And that can help you take advantage of kind of mean reversion. But as I said, better for more active investors. Now, some people have asked about when to sell, what stock rank to sell at. And I've been sharing this, which is a screenshot from this great bit of research called Combining Factors by Christoph Reschenhofer. And he shows that simple buy and sell rules can maximize returns. He used quite a similar kind of ranking methodology to what we use, which looked at profitability, quality, value, and momentum. And he put them together in a similarly a percentile ranking. And he ran tons and tons of like back tests on all the combinations of when to buy, when to sell. And yeah, in the paper, there are some different he looked at large caps, he looked at small caps, different regions and so on and so forth. So, but there's a kind of a general theme here of there being an optimal buy sell point. And for example, there was an optimal buy sell point he found. It's kind of at about 93 and 73, but I wouldn't read too much into the exact levels. I know a lot of people that I've talked to often buy at like 95 and they'll sell at 70, and they found that really works for them on threshold investing. And one example, I don't think I've got it in here, is Reach, which is the old Trinity Mirror, which I owned through when it out of the pandemic, and at about a price of £1, and we owned it in our investment club too, and at about £1 it jumped to a kind of a 95 rank or something, and owned it, and it quadrupled, and at about £4 it then dropped through 70, and I thought this is overextended, I'm getting out. And now it's dropped back down below £1. So there is a lot in this, and it doesn't work all the time, but it's just that's a sort of anecdotal kind of thing. Yes, so I'm being asked for a one-day course. I completely agree. I try and pack so much in these things, and I do agree. One thing to be aware of is, and I'm almost coming to the end here before I get onto FAQs, so I will quickly show you how you might sort of construct a NAPS-esque portfolio in this way on the site. And I'm going to show you the international returns. Some sectors have lower stock ranks. For example, healthcare and tech shares, because they tend to hold more premium, higher valuation shares, you don't tend to find as many high rank shares in those sectors, and they're often smaller as well. So one of the things on threshold rebalancing is to think, well, if you buy at a lower rank, you can often set your threshold for the sell point lower, because otherwise, it can cause some issues. And, I think that's an important, very important point. So building a portfolio, let's jump on the site, and I'll just show you very, very quickly. I've kind of put like a naked webinar portfolio here, and I'll show you a very, very quick way that I might do this. I'm going to use the screener. I've got really kind of two ways of doing this. I'm going to show you both very quickly. So for example, let's say I'm trying to build a portfolio of high QM rank shares, quality and momentum shares. Okay. So I might sort by QM rank. You could do this by P ratio. You could do it by, there's so many great metrics in. You've got the magic formula from Greenblatt and everything else. So lots of ways of doing this, but this is an illustration. And for example, I would add to this market cap, which I can search for, or I can go to size market cap, and let me add that. It's in all kinds of currencies. So if you're in America, you'd have USD and so on and so forth. And I'm going to, personally, I like using sort of less than 20 or 25 as a kind of a limit, because it keeps out all the really tiddly microcaps. If you're a stock picker, you might love the tiddly microcaps, but I kind of tend to keep them out. The other thing you might do is add, for example, the bid-ask spread, which is quite useful. And this is the difference between the buy and sell price. And one thing I do is put 500 in here because that means that the spread is less than 5%. And, you'll get the column added straight away here. So that's a couple of things. And one thing I'll do, let me just save that very quickly as my webinar screen, right? Oops, I've already got one of those. Webinar, just call it webinar. And it'll be put in my sidebar right about there. Okay. So anyways, now, what I could do is I could go down this list. I could go, right, I'm going to try and build a portfolio with a basic material stock. I might try and find another one. And then I can just click add to folio. And this could be a watch list or something I'm constructing a portfolio from. And I click add. And I could do the same. Obviously, I can add a sector rule here. So I could go sector, economic sector, add the rule. And for the next sector, let me just say energy. Okay, so you'll see in the drop down here 10 sectors in those super sector groups, and then that's a nice easy way of me going, whichever ones I like. I might go, that's got too high a spread, maybe it's too small, I hate the company, I prefer Shell, whatever it is. You might have your information on the shares, but then you can add those to your list, and as you go through that, you can build it all up. I'm going to do literally every sector right now, just to show you what kind of happens and how you can use the portfolio tools as you do that. So cyclicals, financials, and you get the idea, antifolio, webinar folio, So that just adds a few different kind of sectors in. And what I can now do is go jump to the portfolio, and then I can sort of analyze it. So I'm going to click straight through. And at the moment, I've got 2, 4, 6, 8 shares in there, sorted by sector. You can see 2 by 2 by 2. And if I go to the allocation tab, I can then sort of see, oh, look, I've only got 8 shares in there, but 3 of those sectors are in cyclicals. And I'm like, crikey, if I was all in cyclicals at the top of the market, this could be this could be a portfolio that suffers. So I then realized, maybe I want to have some defensive backing. So I'm going to go and look for some consumer defensives or some healthcare or utilities. I'm not going to go to the screener to do that. I'm going to go to the sector page, because that's the other way you can do this. Go to the sector page, and I'll go and look for some consumer defensives, let's say, kind of food stocks and so on and so forth. Now, you might want to customize your view to use the ranking that you were using, but I'm going to switch to the ranks table here, which has got, for example, now I can customize this and find the QM rank, but I'll just use the stock rank for speed and brevity. And I look at this and I go, okay, here's a couple of shares, add to the portfolio, once again, add. And, I'm doing a very, very kind of basic thing, and I implore people to do a lot more research on shares than I'm doing right now. But you can see then there are defensives in there. And you can find that these tools will really help you build comfort in your sort of super sector diversification. We call the super sectors are color coded in purple, cyclicals in purple, defensives in green, and sensitives in yellow. And it's a really, really useful tool. And there's some other things in here which can be quite beneficial. So hopefully that kind of gives you a bit of an illustration and of how to use those tools. Now, obviously, don't buy on the Stockopedia site. You use a broker to do whatever you're going to do. This is not advice. Do your own research. And everything else. So important to understand. Now I'm going to look at the international shares, the way this has worked, the international results. Now this is back tested using our archive data. So we've been tracking this, different regions we started at different times, but I'm going to quickly explain the rules of the game for my back test. So the factors, this sort each region stocked by descending stock rank, QVM. So this is all just using the plain vanilla stock rank. Minimum rank is 75. Minimum market cap of 20 million sterling at the point of purchase. I know if you're in America, you use dollars and Aussie dollars, in Australia, and so on and so forth. In terms of diversity, it's 2 by 2 from each of 10 sectors. Now, some of these regions don't have enough stocks above a 75. So sometimes in the test, it can go down to 17 stocks or so in the back test. And rebalancing was just annually rebalanced with equal weighted portfolios. So this is a very kind of straightforward way. And starting in 2013, we had all of Europe added to the site. And the performance of the European shares has been very, very strong. The rankings in Europe have been very strong. They've done extremely well. There's been a lot of good quality value shares all across Europe. And there's been some stunning results to some of the guru screens as well. The Slater Zulu Principle and Can Slim have done amazingly well in Europe. If you're somebody who likes screening, expanding your universe to broader markets, suddenly when you're finding there's low candidates at the moment, if you expand it, it's really powerful. Germany, very strong results. France, good results, not as good as Germany. Scandinavia has, these are all from 2013, these are Europe. Scandinavia has been extremely strong. I'm not sure why. It may just be, and you might know Swedish investors love the stock market. And this is across all the Scandinavian. If any of you are calling in from Scandinavia, please do let me know, because I've been to Sweden quite a lot of times, and both for work and for pleasure. And I love all the Scandinavian countries. My wife and I go there every year. But anyway, Eastern Europe, not as strong. These are more, this includes Poland, Hungary, some of the other countries over there. And so rather than sort of like what you might think of as more Western developed or more developed Europe. And in 2014, we included American shares. And I think this is really interesting because the overall stock ranks have underperformed the S&P 500. And one of the reasons, and I often get that question, why don't the stock ranks work in America? And the reason is because it's got evaluating. The overall stock rank has a strong bias to cheaper shares. And America is hugely, hugely dominated by mega caps. And the index is market cap weighted. So the Apples and Amazons and those sorts of shares have an outsized impact. And really all active managers sort of underperform these indexes in general. And the stock ranks have underperformed. But since the bottom of the pandemic, I can show you actually, but if you go on that performance tracker, they've crushed the S&P 500. The QVM since the pandemic low have really, really dominated the S&P 500. And that's one of the reasons why you see the NAPS in America has really done fantastically well since then. So I'm quite pleased, and it shows you the impact of sector diversification and so on, is that this portfolio has outperformed both the stock ranks and the S&P in that environment. And I know many of you anecdotally told me you've used this in America and have done really well, so it's really good to know. If you just focus on NASDAQ stocks being a growth market, QVM doesn't do so well, but has almost matched it. QVM hasn't had such a massive drawdown. In 2016, we added Asian and Australasian shares. We've actually gone into partnership in Australia, got some great guys running the Australian site down there. And so if any of you, I'm married to an Aussie, so and I love it down there. I was down there for Christmas. And Elio and Chris are doing a fantastic job for subscribers down there. And the NAPS have done very well there. And they have actually launched a NAPS portfolio for Australia. So that's well worth checking out if you invest in Australia. And that's done very, very well. And India smashed it. Very hard to invest in for UK investors, but I just think it's quite interesting. Japan, less so. Japan is a tough market to beat with factors, so quite interesting. But that's just sort of generally quite a sort of proven factor framework, because we cover about 82 exchanges, and I keep threatening to expand it to Brazil and places like that. So anyway, I'm going to try and answer some questions now. If anybody, that's an hour and 15, I said it would be an hour or more. That's most of the learning materials I've got time for. I'm going to try and answer some I'm going to answer some survey questions first, and then I'm going to try and answer some live ones. So let me have a look. And first of all, if you're putting, I think Lawrence might have flagged a few questions for me, and I'm going to try and answer some of them. I promise my wife will get home later, so I will try and not take too long. First of all, somebody said, how would you start a new portfolio from scratch using these kinds of principles? I've just been doing it. So I'm going to explain what I would do, what I am doing. So this is a personal example. So in in about mid-2022, I began running a new £100,000 portfolio for a family member. And he has, I was sort of given a mandate, and it's more than that, but I'm managing 2/3 and someone else is managing a third. So that's my part is the 100 grand I'm running. And under some pressure to invest it in all kinds of different ways, I waited patiently for the market to bottom. And I did that using a timing signal. I have written about it a couple of times on the site, but I've been tracking a timing signal. The next slide shows it, but there is a timing model on the site, and this is going to bound to open in the wrong tab. But if I show this, I wrote a blog about it, and I've talked about it in one of the NAPS portfolios, but we'll try and I can probably share you the link on this. I'll just put it in the chat box if anybody is interested. So that's a trend indicator on the UK markets, and that explains it. But in essence, it triggered a buy signal about the 12th of January. And this really is a timing model based on the FTSE AIM All Share, which is a very sentiment-driven index that trends, and it uses the moving average. And so I waited and waited and waited as the market fell. And when it missed the bottom, didn't invest the bottom, but has invested now. And what I've done is I've invested a third of the portfolio in 6 high VM rank shares. As I said, I like value and momentum, and half of the NAPS is in value and momentum. But for this portfolio, I'm focused on value and momentum, and a third of the portfolio is invested in it. So I picked out 6 shares, and which one of them was Energy, Smiths News, SPI, Mears, Kitwave, and TBC, which is a Georgian bank. And those names. So what my philosophy on this is, I will wait 3 months, and if the timing signal is still in the buy zone, in other words, above the moving average, I'll invest a third more, and I'll wait another 3 months. Now, there's lots of philosophies on this. When I was working as a Goldman Sachs wealth manager, I mean, it was a very bull market at that time. And one of the problems in the world at the moment, although there were different problems then, we used to have a philosophy of just investing immediately, everything. And it really, obviously somebody said they tried that a couple of years ago and it hasn't worked out for them. So you can take a more drip in, and many people use sort of dollar cost averaging, and people save into portfolios and add incrementally over time. But this is one way that I'm actually starting a new portfolio from scratch. And I've chosen 6 stocks from 6 different sectors with a high VM rank, and that's how I'm doing it. If the timing model turns down, I'll just wait. We won't sell those. I won't sell those shares. I'm just going to hold on to them, et cetera, until the next third gets invested. So that's that. And I expect to use a combination of threshold and calendar rebalancing. So that's just the way I'm probably going to do it for this portfolio. And I think that's a really interesting question that was asked, and I just thought I'd give that example. Thankfully, U Group is now up 25% since that buy price. I just actually want to show you that. And remember, I don't actually have I'm a trustee of this portfolio. I don't actually own it personally, but there are people I'm managing this for that do. So I just disclose it. But this is one of my points on buying momentum shares. I was just like, how can I buy this? How can I buy this at that point when it's already 5 bagged? And then of course, last week if I just show you year to date, it suddenly spiked on a 10% on a really good announcement. In the news, it said that its full year revenue is going to exceed target, and the stock went up. So that's the kind of thing that can happen. But that's momentum shares are really hard to buy, and I certainly wouldn't encourage anyone to buy a portfolio of shares like that, all at like gone up that much. But it's as I said, psychologically it's really challenging. So that was my timing model. I won't go over it now, but you can read about it on the site. Now there's always a question: is performance improved by using stop losses? And get a lot of questions on this, and I just wanted to answer this question before going to the live questions. My view is, and this is research backed, and I could share links to the research, but I'm going to do that hopefully in different writing later in the year. Stop losses generally reduce downside risk, but they don't necessarily increase returns. And that's pretty proven in the research. I find, now I know many of you will have used stop losses very effectively through the pandemic and in the decline, and you would argue against this. But in general, they minimize downside volatility. So stop losses are very, very good for risk reduction. If you're someone who really, really doesn't want to lose capital, stop losses will reduce your downside risk. You will obviously go to cash much more regularly. And I know like Mark Minervini, Bill O'Neill, those kind of investors use very, very sharp and tight stop losses, and they get you out of the market in bad markets. So capital reservation really, really helps. But you must get back in. And I think that's where most people really struggle. Like, it's very hard to get back in when you're in cash. And, that's something to always beware of with stop losses. Now, the other thing is, one stop loss rule does not fit all. And I hear many people going, oh, what level of stop loss do you use? And they sort of talk to each other and they go, I use 10%, 20%, 15%. But of course, every share has a different volatility, a different risk rating. So on the site, if I go through to any share, okay, here's Sylvania Platinum, which is a great winner for our investment club a couple of years back through the pandemic. We had a great run. It's got a speculative risk rating. Now, this is a really important word. And if you click it, you'll get a little write-up. And you can also read the ebook on this, which I wrote quite a long time ago. It's a very short ebook. And it's a great read on volatility. And there's also articles in the guide. So, but you can go and read that ebook. But in general, do learn about the risk rating, because it's quite powerful. And the reason is because different shares have different risk rating or volatility. The risk rating is based on volatility. And I'll explain that in a moment. I'm going to explain it right now. So 20% stop losses don't work for all shares. So, for example, if you use a 15%, the different risk ratings, and most private investors use kind of balanced, adventurous, speculative, or the really, I guess, much more gambling private investor. They invest very heavily in highly speculative shares, and highly speculative shares have an annual volatility of 70% or more in the share price. And how can you set 10, 15, 20% stop loss on a highly speculative share? It's just, you get stopped out immediately. Like, in the typical month, it will go through that level. So you need a wider stop on higher volatility shares. And it depends on your finesse and your ability to time your buy entries. And, that's really key. But I personally believe different stop levels for different volatility classes of shares makes a lot of sense. So that would be the one thing I would say on stop losses to add to what I've said already. Now, people have asked me, have you tested stop losses on the NAPS? No, I have not back tested this. And I think and know it would get the portfolio out of a lot of the worst performers, but the portfolio has to get back in. So do you hold cash to the next rebalance? Do you get back into the same name when it gets in? There's a lot of considerations. And also, when you test on this, remember, shares often fall very rapidly through stop losses. If there's a bad announcement, I remember DX Group once fell 65% in a day and it had a 99 rank. You're not going to get your 20% stop loss if it falls 65% in a day. And once again, in our books section on the site, you go to learn and you've got this great thing called books. We've written a bunch of ebooks. Hopefully that will work. And the risk rating book is here, but there's a profit warning survival guide. that's really, really worth reading for how to deal with profit warnings. It's a really, really good bit of research, leverages all of Paul Scott's work. But there's some great intel in there. But my point is, on a profit warning, you will see, and I think the chart maybe even be on this page. Yeah, the average profit warning, stocks drop like 20% in a day. So stop losses on profit warnings kind of don't work. It's quite hard to attain your stop level if there is a profit warning. So that's really worth considering. Right, I think I'm going to go to some live questions now. Gulp. I know it's been almost an hour and a half. Feel free to go get your supper and everything else. I'll try and do 15 minutes, but I won't take up much time. Let me see if I can have a little look. Okay. There are some questions on dividends. Oh, yeah, because there's a question for, can you use the NAPS system on income investing? And again, this is something I really should model. I think we should have a model portfolio on income investing. So I'm going to answer that question. That's really good from Gareth. And okay, let me answer that. So if I could jump to the site again. So if I go back to the screener, if I go straight to the webinar screen, now I'm going to slightly adapt this. I'm okay. Actually, I'm just going to use the overall stock rank as my sort mechanism. So I'm sorting by descending stock rank. And I'll use the same market cap, bid-ask spread, constraints, and I'm going to add a rule. And in here, you can use yield, dividend yield. And okay, so I've got a forensic analysis webinar that I will do for subscribers soon. It's on, the old one is on the homepage of the website. It's been viewed a lot, but I'll go into what some of these things really mean. The TTM ratio is the trailing 12-month yield, whereas the rolling ones are, rolling 1 year is a rolling 1 year forecast, and there's also some averages. So I'm going to use the TTM, the trailing 12-month yield. And if I look for that to be, depends what yield you're trying to attain. If you were to go and put like 10% yield and above, I would say you're probably not going to attain that yield. It's very, very hard to attain yields like that, and we've got an ebook on dividend investing, so I would not, and very high yield, very, very high yield stocks are much more prone to dividend cuts and so on and so forth. But let's say you wanted to try and find a 4, or let's say with rates getting so high, a 5 or 6% yield, you can see on a trailing 12-month basis, above a 20 mil market cap, there's 113 stocks in the UK, and which have those numbers. If you're in Australia or other markets, as an example, hopefully this will work. I need to add that again. But if I were to do the same thing for America or Australia, etc., and use the same thing, you might find, depending on the market size, again in Australia, 132 stocks, and you can do the same sort of principles. Now, when there is a really, really high yield, you might think, it's at risk of cut, and a lot of people like to add certain protection on a dividend portfolio, like adding high dividend cover. For example, maintaining a very high quality. So one of the things I personally like doing is just making sure there's quite a high quality rank as well. So, if I can make sure that's 90 plus, it's going to whittle the size down again. And if you're really scared about super high yields, you can actually add a rule to exclude them too. But again, this is a very good way of building a dividend portfolio, and you can do the same kind of thing. You could do 2 by 2 for each sector, or you could, however you want to build it, using your own insight, your own intel, and add to a portfolio. And I'll just add it to my webinar portfolio. This will be a mix of Aussie and UK stocks now, but you get the idea. And that is, you can then sort of see what the average yield would be. And generally higher ranking shares have a better yield anyway. And one of the things I like to do is copy the data to a clipboard. And let me just start a Google Sheet. If I was to go, for example, and just go very quickly, open a new Google Sheet, I can just paste it in. I don't know if you use Google Sheets or use Excel, but you can paste it in. You can then do things like calculate average, equals average of the portfolio, and that will give, or the watch list, or however you're going to do it. And then that starts showing you a kind of an average yield. And, you can do a lot of analysis in spreadsheets you can't do in Stockopedia. I know a lot of people use spreadsheets, and that's a really, really good way of doing it. And you can also export to Excel if that's your preferred one, or CSV. So that's really helpful. Hopefully that answers the question. And yeah, anyway, I'm going to try some others. Paul, that's a good question. Have you considered using non-correlation rather than sector diversification? I completely agree. It's a very, very good idea. And I think what we need is, and I do a lot of work in Python myself, and I like programming these things. And but actually, what I have found is that, you know, simple heuristics. I've got a book, Simple Heuristics. If you don't know what I don't recommending this book, but Simple Heuristics is by Gerd Gigerenzer, who has some fantastic books on Amazon. One of them is called Risk Savvy, but this is a kind of much more academic book. But heuristics are rules of thumb, and simple heuristics that make us smart. Simple rules of thumb often, you know, do almost as well as very complicated processes, and they outperform, especially in areas of uncertainty. One of the interesting things, I know, Paul, you must be quite an advanced investor, and one of the interesting things is Harry Markowitz, who created mean variance optimized portfolios, which is kind of like risk weighting, like I mentioned earlier. He sort of got a Nobel Prize for this extraordinarily difficult way of you know, managing position size in portfolios. He admitted to using equal weighting himself in his own portfolio. So there you go. So anyway, that's quite an interesting point. I know there's been a couple of questions on growth stocks, and Rebecca, I hope I answered your question on sell triggers on ranks, and so many questions. ESG, Jeremy, at some point we'd like to add ESG ratings to the site. There's a good friend of mine who is sort of presenter on these things, and I would like to add the ESG ratings. So I don't think they do not have as good performance in the market, but a lot of people want to filter some of the more suspect shares in the market. I am very well aware that the high ranked shares often have a skew to, like I said, more unpopular sectors. You often think of them more as sin stocks, or some people do. But for example, energy shares in oil and gas, and coal, and so on and so forth. Although I think energy security has become, you know, quite a significant factor. I even found recently defensives like BAE Systems in the UK, which, you know, sell a lot of military equipment and so on and so forth. I think became like an ESG stock when the war in Ukraine started, like jumped so much in February 22 as the war started. And, you know, it was a great time to buy. Again, this just shows you the power of momentum in a share. It jumped so much you know, I'm smiling. It's an absolutely awful situation, obviously, that's triggered this. But it was interesting that ethical, it sort of was seen as more ethical. Security is seen as more ethical in certain scenarios. So ESG does drift, but we will try and get the data in. Let me have another look. Big fan of Lawrence Bensdorf. I don't know that. High div shares. Let me just have another think. Data quality. Yes, I mean, this is always a good question. I mean, obviously, I'm sure you know how we I think I've got a slide on data here. Yeah, our data process. So one of the things on data quality is we are among the top 3 submitters of data because of our amazing community here, all you amazing subscribers who send us, whenever there's a data glitch on a stock, you will send us a message. We send it on to Refinitiv, which is our primary data provider. We now use Smart Insider for direct to deals and others as well. But Refinitiv are very, very responsive. They do have a standardized financial process that they employ hundreds, maybe thousands of analysts. I've met some before in India and all around the world, and they scan in all the data, and they have a process which audits it both automatically and manually. And we import that. We also standardize it, clean it, and so on and so forth, and then do our computations, and then we publish it. Now, the community, one of the wonderful things of Stockopedia is we've improved the data quality of Refinitiv astronomically. If you don't know who Refinitiv is, they are the main competitor to Bloomberg. Refinitiv was spun out of Thomson Reuters and is now owned by London Stock Exchange, and they are kind of one of the primary suppliers of data to the institutional industry. But because of the amount of subscribers we have, most hedge funds will just buy the data, calculate, use the data they're given, and they don't calculate their own financial ratios. And I know that I've been, friends in the industry have told me that our ratios are more accurate than almost any that they get from any other any suppliers. And I think that's really, really interesting. And it's partly because it's down to you guys. You kind of tell us if there is an issue. But one of the key things on systematic investing I found is that the data error rate, especially when you use rankings and it sort of rolls everything up, the data error rate is far, far lower than the human error rates, and definitely my human error rate and my biases. So I think that's quite an interesting thing. We're always working on data quality, and we've got a great analyst team, and we work really hard on this, and it's very difficult, but it's good it's been brought up. And I know I'm going to probably sign off soon. If you've got any other questions, fire away. And would we consider adding level 2? Yes, we would, but it's not going to happen this year. So we are working on changing our subscription structure to do higher value and more interesting things that will help us sort of, obviously there are some things which have more costs, which you have to pass on, and some things which add a lot more value, which, I think people might, be willing to pay for more. And I think there's a lot of things we'd like to do. And I think we are in an active development team are fantastic here, and I can't praise them enough. And one of the reasons there wasn't as much development in the last 6 months is we had to shift all our payment systems from one place to another. It's a bit of a really difficult bit of work, and sometimes you've got to do that sort of stuff to stay in business. So will we ever offer backtesting? Yes. I mean, I backtest using my own Python scripts. I'm lucky I've got access to the archives. That is all on the roadmap. It will take time. It will take time to mature, and there's lots and lots of work to do, but we will get there. And will we add directors dealing screens? Yes, we will. We wanted to. I mean, you probably have seen, for example, let me just bring up, Wes Farmers in Australia, and you've probably seen, those of you that know, we've got a directors dealings tab, and this shows for global stocks the directors deals data. The team works super hard to get this data in there, and we've got it on all global stocks. Well, not all global stocks, but the vast majority above a certain threshold, and it's really, really fantastic. It's not in the screener yet. We will add it at some point, but it's just like product roadmaps. If you've ever run a product business, there is always so much work to do, and there's so many demands. We've got thousands of requests from subscribers, and we do stack rank them, and we do work through them. And but obviously there's also business things to do as well. We also have all the major shareholders in there as well. We want to get those sorts of ownership metrics in the screener too. So it would be a fantastic addition. And please do send in your suggestions. You might even talk to me, when you click that and send a message. There's the wonderful Sam Keelan. You can send a message in there, and support team will kill me for encouraging everyone to send more messages, but you can put them all in there. And we will add in, and we are planning on adding investment trust and fund data, but it's been challenging to do it yet. We want to add more portfolio analytics first, because then when we add the investment trust data, we can actually roll the analytics onto all the holdings of investment trusts, ETFs, and portfolio and funds. So when we do add it, we will have a really fantastic proposition. So I don't want to do anything by halves. I want to do things well. Is the momentum rank mainly based on movements on share prices or profits? Okay. One thing I would say, I will do a ranks webinar at some point. If you go into StockRanks and rating in the Learn section, you can see the momentum rank article in here. And this explains how we calculate it. And it's a combination of price momentum factors and earnings momentum factors. And this is one of the things we want to develop, is we want to expose the actual inner workings of the stock rank, and so you'd be able to click on the ranks and you'd be able to sort of see the inner workings. So I think that was Robin Davies. It's about 50-50 in between price momentum and earnings momentum. And that's an important thing to remember. But for stocks that do not have earnings forecasts, it's all price momentum. So if you're on a share, let's have a look at U Group again. This does have earnings forecasts, and you scroll down to the analyst forecast, and you can see there are forecasts. There's only a couple of brokers, and there are some forecasts for this year, and they've significantly jumped in recent months, which creates a higher momentum rank. So this momentum rank will be a 50-50 split between the price momentum, which is based on mostly 1 year and 6 month relative strength, as well as some of the moving averages and the 52-week high, and also some earnings momentum factors such as earnings surprise. Has it beaten the numbers? Are the brokers increasing their recommendation? And are they increasing their estimates? So you can see the estimates here. And that's what rolls into the stock rank. But if it doesn't have those, it's all price momentum. And that works pretty well, actually. I like it because actually it makes the momentum rank sort of actually slightly a fundamental factor too. It's not a pure price momentum factor. And I think that's sort of smooths it out a bit. Any analysis done on using StockRanks for short selling? Well, look, I will say my own personal point of view here, because I've used it a lot to create long short portfolios, which I spread bet. And so, sometimes it does fantastically well. And 1 year I made 75% doing this. And because, you know, you can get this spread between high and low rank shares. And you know, let's have a look since let's say over the last year. So for example, let me just get the FTSE All Share. I think we've got to sync up the latest quarter of data in here. But anyway, you can see that the high rank shares have lost money, but the low rank shares have lost a hell of a lot more. And if you were long high rank and short low rank, you'd be making a spread. But there is a big problem there, which is that most brokers stockbrokers generally don't let you short unless you've got a broker on the phone. And obviously they're more expensive. And you might be able to find some stock to borrow from some of those, from somewhere. But on IG or a spread better in the UK, and I know in America there's more of an options market. In the UK, it's a spread betting market for individual investors. But you can basically short sell and go long and try and earn that spread. Now, I have done that quite a lot, and it has been very effective. But the problem is most of the shares you cannot actually short, and they just don't let you. And that causes all kinds of problems. So there is a page on IG, which I use for spread betting, which actually lets you download a list of all the shares you can short. But then you've got to try and filter for them. You've got to use Stockopedia, and you kind of got to go and create a screen, find all the lowest ranked shares on the market. And let me just try and do that. What you can do is go ascending. Sorry, these are Aussie stocks, but you then find all the lowest ranked shares. And I can guarantee you can't short these low market cap ones at all. So, you know, even I find you can only short 100 million market cap plus companies in the UK. And that means you kind of got to, it really constrains you. But I have basically personally had some good success in shorting across much wider amounts of shares. But anyway, that's more advanced. And thank you so much, Dermot. I'm probably going to call it quits here because it's been an hour and 45. Dermot, that's so kind of you to say, love Stockopedia, brilliant webinar. So thank you so much. I'm promising to do more of these in future, and hopefully in the not too distant future. I've been really overwhelmed by the number of people who signed up to this webinar. And I think, you know, we probably had 800 plus of you live, and we had more than 2,000 subscribers sign up. And I know many will be catching up on the replay. So thank you so much for your time. And I will hopefully see you not too far away. And if you are in the UK, often go to, thank you so much to all of you, Judith, Robert, all of you for your very kind words. Thank you so much. And please thank Lawrence. I know he's been doing a fantastic job supporting this. Lawrence, you need to get your supper. You need to have a lie-in tomorrow. Thank you so much, everybody. I'm going to call it quits there. An hour and 45. Many, much appreciated. Good luck in the markets. I really hope we don't see new lows. Really hope the market continues its recovery. I don't predict the future. I don't ever like to. I personally believe in factors in, generally outperforming the market as a whole, but that doesn't mean they go up. And so be safe investing and all that. Thanks a lot. Take care all.